Digital Realty Trust recently reported second quarter results. The stock is up a little bit so far this year, but it is still way down from its all-time high. Investors looking at that dividend yield might be thinking about buying right now. But the question is that high yield safe? I'm Jason Hall. This is The Smattering. And I've got Jeff Santoro on here with me. And we're going to talk about that right now. But before we do, just want to remind everybody, we have a great sponsor for these videos. It's the Motley Fool. If you're looking for more great stocks to pick from than just Digital Realty Trust, go to our special link, fool.com/The Smattering. The Fool is going to give you its 10 best stocks to buy right now. Hey, Jeff, you've had a chance to take a look at Digital Realty's earnings. What do you think so far?
I bought this stock a few years ago because I really believed it was a leader in a really important part of the commercial real estate market, data centers. There's going to be more data in the future, more need for data centers. But I sold it a few months ago because I saw some trends that I was concerned about. And honestly, this quarter just showed me that those trends have continued. So for example, while revenue growth has ticked up the last couple quarters, gross margin has been on a downward trajectory pretty much for the last 2 years. Similarly, FFO per share, funds from operation per share, and core funds from operation per share, which are proxies for earnings per share when you're talking about REITs, they're at levels that we saw several years ago. In early 2018, they were around even a little bit higher than they are now. In fact, since March of 2022, that's the last time that Digital Realty Trust saw its FFO per share grow year over year. So I'm just worried that they are heading in the wrong direction. They're facing headwinds that I'm not so sure they're going to see their way out of anytime soon. But I don't know, maybe I'm missing something. What are you seeing?
We're definitely in a cyclical period where the data center space is a little bit weak. There was a massive amount of build out that happened over the past 5 to 10 years. And we got a little bit of ahead of where demand is going. And we've seen a lot of tech companies have started to pull back a little. Now, the flip side too is we've seen a lot of focus on AI, right? So there could be some boost if we see companies really focusing on AI. But again, that's just a small portion of the total demand. I think it's easy to see something like that and maybe kind of fall in love with the possibility of it being like a kind of a hidden AI play. But I think that's a little bit overstated. Again, the reality is that where we are in the cycle, and you look at those trends you talked about with its economic results, and they're not great. One other thing that I want to point out too is that if you look at from the first quarter, ended the first quarter with guidance for core FFO, again, that proxy for earnings per share for REITs, a range of 665 to 675 per share. They lowered that. The prior low end of guidance is now the high end of guidance. Another thing is if you look at their investment activity, what are they divesting? What are they reinvesting at? They did sell a data center in Texas for a cap rate of about 4.4%, which is good. They acquired an asset at about an 8.3% cap rate, which means they got a good discount, but it's a tiny investment, like 15% of the size of what they divested. You look at other divestments that they're making and the cap rates are not great compared to what they were spending to buy not that long ago. One thing we didn't talk about, Jeff, I think is really important too, is we talked about the weakening of their results and the trends are definitely negative. And we're in a weak part of the cycle, and you think eventually maybe the cycle does start to turn. But one of the things that's really important with Digital Realty Trust is refinancing their debt. REITs use a tremendous amount of leverage to acquire property. And again, it's backed by the asset, so they can generally get pretty good terms on it. Generally, it's fixed terms. But those really low interest rate fixed terms that they got over the preceding decade, they're going to have to start flipping that debt at higher rates. And that's going to be challenging. So even if we do see the data center space start to strengthen a little bit, I am concerned that because of the refinancing activity and the higher interest expense, I do think you have to be really cautious about thinking about their dividend as being ultra secure. I think it's probably okay. I don't know if they're going to continue to be able to growing it like they have over the past 16 years. They may be pushed into a position if some of their lending partners say, look, we need to see more of your cash flow be unencumbered.